A partnership may be formed where two or more individuals want to carry on a business together with a view to making a profit. A partnership is essentially a sole proprietorship multiplied by the number of proprietors. Many retail, service, and other businesses are operated as partnerships. For example, a grocery store or service station may be operated as a husband and wife partnership. Similar to sole proprietorships, the partnership does not have a separate legal identity distinguishable from the partners. And because there's more than one person involved, forming a partnership is much more complicated than starting a sole proprietorship. Also, because there is no separate legal identity, the profits from the partnership flow through to and are reported on the partner's personal tax returns. There are three main forms of partnerships: general, limited, and limited liability partnerships. There is also another business structure that acts like a partnership but isn't one, and that is a joint venture. We'll walk through each of these partnership structures, starting with general partnerships. A general partnership can have several benefits. More skills can be available to help the business because of the greater number of people involved. This means there can be management specialization, as people with certain skills can be in charge of their relevant area of the business. Better management will make a company more competitive. Finally, the partnership may have more capital at its disposal than a sole proprietorship. The company's ability to obtain credit may be greater than that of a sole proprietorship because the personal assets of the partners can be relied on to provide collateral for loans or to settle debts of the business if necessary. There are also disadvantages to a general partnership. For example, partners are jointly and severally, individually or together, liable for the debts of the partnership regardless of the origination. Creditors can sue the partners personally to recover any amounts owing to them. For example, if all the partners had modest resources, with the exception of one millionaire, the assets of those others might not go very far toward meeting claims. If necessary, recourse could be taken against the millionaire by claimants to meet the balance of claims. An investment of $1,000 in a partnership could theoretically cost one partner over $1 million. The partnership arrangement should be documented in a formal agreement outlining the terms under which the partnership is formed and is to be operated. The partnership agreement should provide for the handling of the various capital interests in the event of a partner's retirement or death, as a need for reorganization of capital investment on short notice could be quite disruptive. If capital needs expand beyond the capacity of the partners, it might prove to be difficult to attract additional partners if the existing partnership arrangement creates barriers to the entry of new partners. Finally, since all partners may be involved in policy decisions, slow decision-making may result from the fact that the various partners' voices have to be heard. It can be argued, however, that this aspect of partnership governance is a safeguard against otherwise rash and uninformed decisions. Another form of partnership is the limited partnership. These partnerships are composed of general partners who conduct the business and special or limited partners who contribute capital in the form of either cash or other assets. As opposed to the unlimited personal liability of a general partner, a limited partner's liability ends with his or her contribution to the firm's capital. A limited partner may share in profits as provided for in the partnership agreement, but must not take part in management of the company. Should this involvement occur, the limited partner will be deemed a general partner with unlimited personal liability. Advantages of a limited partnership include the fact that liability is limited only to the amount of capital contributed by limited partners. Also, general partners can raise cash without involving outside investors in the management of business, a key point for limited partners to retain their investor status. One of the disadvantages of a limited partnership is that the general partners remain personally liable for business debts. Considering that it is more expensive to create a limited partnership versus a general partnership, the intention of a limited partnership must be evaluated carefully. The most common type of limited partnership is related to companies that invest in real estate. Limited liability partnerships, or LLPs, are an extension of a general partnership. An LLP is essentially a general partnership, but where all partners are protected from the actions of the other partners. Essentially, all partners have limited liability. This is different from a limited partnership, where there must be at least one partner with unlimited liability. In some jurisdictions, legal firms, accounting firms, and others are limited liability partnerships. In such partnerships, a partner who makes an error, or perhaps defrauds a client, is fully personally liable for the damages flowing from that error or fraudulent act. The liability of his or her other partners, however, is limited to the assets of the partnership. As with all other partnership structures mentioned, LLPs maintain their flow-through taxation status. While LLPs may seem enticing compared to general partnerships and limited partnerships, some jurisdictions restrict them to certain professions, such as lawyers, doctors, and accountants, as mentioned previously. Therefore, a business owner may not always be able to create an LLP. A joint venture, or JV, is a variation on a partnership arrangement. Typically, a JV is used as a means of pooling the resources of two or more entities, either individual or corporate, to complete one particular transaction. Generally, the scope of the transactions entered into is more narrow than it would be for a partnership. The ability of the JV partners to contract on behalf of each other is governed by the joint venture agreement. The key distinguishing elements between a joint venture and a more typical partnership can be summarized in the following general features of a JV. It has a limited purpose. There is a sharing of gross revenues rather than profit. There is a limited right of agency, so that each joint venturer is liable only for an agreed-upon portion of the joint venture's debt. The right of each joint venturer to dispose of their interest in the property is governed by the joint venture agreement. There are some definite advantages to establishing a JV. For example, for higher risk projects, it allows for the sharing of those risks with a venture partner. Also, a joint venture allows for flexibility. Often, JVs are set up for a specific project, and when the project is completed, the JV is dissolved. On the disadvantage side, it takes time and effort to build the right relationship, and partnering with another business can be challenging. Here are some examples of limited liability partnerships that demonstrate what I mentioned earlier. They're largely professionals that have organized their partnerships to be protected from a professional liability perspective. Regarding joint ventures, here are just a few recent joint ventures between international companies. You can see that they were formed to allow for the combined expertise of the companies to create new products and services, where to do so independently may have taken too much time and resource and also taken the companies away from their core competencies.